Awesome. So we are live on YouTube as well. Welcome everyone. Thanks for joining in today for our webinar on multi-factor investing. We have Mr. Sandeep Tyagi with us, the founder and CEO of Good Luck and ST Advisors. We are very glad to have you here, sir. Just before we start, here's a small housekeeping we would like to do. If there are any questions you would like to ask, please feel free to do so in our comment sections. And for the participants who have joined on YouTube, please feel free to do it on the comment section of the YouTube. And there is any particular problem you might face, just ping us. And Mr. Sandeep Tyagi requires no introduction. He is the chairman and managing director of ST Advisors, an investment management company focused on providing risk optimized returns through predictive models and data analytics. He has 30 plus years of experience in portfolio management, analytics, and consulting. Prior to ST Advisors, Sandeep was the founder and CEO of Indictus, one of the earlier analytics outsourcing company. He ran the Indictus for 8 years before merging with ELX Services. Over to you, Sandeep, sir.
Hello, thank you so much. It's great to be connected to Dhan and all your investor base. I'm happy to be here. So the topic for today is multi-factor investing. What I'll be covering is a little bit of my background, a little bit of background of the company, and then talk about multi-factor investing. So let's see if I can share this. Let's get started. First, let me introduce a little bit of the company in depth. ST is a 14-plus-year-old company. We started in 2008. We were one of the first companies to get algorithmic trading approval from SEBI. And we are only focused on quant and algo trading. So the core of what we do is everything using algorithms and machines. About a year ago, we also went live with Good Luck. Good Luck is an investment advisor, and it is meant to create quantitative model portfolios for investors to help invest their individual savings. And we provide that through partners like Dhan. It has had a good run. Uske bare mein, we'll talk more about this. Now, let's get into factor investing. What is factor investing? And I don't know if you follow us on our Instagram reels, but there you will see that we had put out a cartoon showing the old story of blind men and elephant. So when blind men look at an elephant, they, depending on what part they can touch, they see a different picture. Either they see that it's, like a fan if they're touching the elephant's ear, or like a rope if they're touching elephant's tail. Similarly, when we look at the market, investors can look at the market in only a partial way. So some people like to think of investing in momentum stocks. The stocks which are going up, they would invest in it. That's looking at the market from the lens of momentum. या फिर वो किसी भी और factor like value investing or particular sector like defense or rural spending. Whenever you focus on one aspect of market, you are looking at that factor. So think of factor as one aspect of finding an investment. Let's talk about some of the factors. One of the most famous one is value. Value means that company's price ultimately uski earning capacity pe depend karti hai. It depends on what is the underlying cash flow and profitability of the company. On this chart that I have shared here, you will see that the the earning EPS, earning per share of the index over last almost 15, 20 years is very much in line with what the total price or the of index Nifty is. So if you see that the overall growth of the price is directly linked to the earning per share. Now, there is some volatility. Maybe during this period, the same earning was priced at 12,000 and then also fell to 8,000. But underlying the core valuation is the profit capacity. Then there is a factor called growth. In this, you can look at revenue growth, profit margin, return on equity. And assumption is that the companies which will continue to grow are the ones we should invest in. So the investors who like stocks like Nykaa or Zomato or other such potentially high growth companies which have growth potential. And in US, this has been extremely successful. You have had the stocks, jinko bola jata hai FANG, Facebook, Apple, Amazon, Netflix, and Google, jinhone in the last decade, they have pretty much given a big chunk of the overall growth of S&P in US. Now, another factor could be quality and low volatility. Quality means invest in companies which have low debt, which have good and steady earning growth, good profitability, strong balance sheet. Volatility simply means companies which don't change their prices too much. So usually they are consumer products company, Nestle, Colgate, Palmolive. These kinds of companies, Asian Paints, they are very stable. They don't change a lot up or down. They continuously stay because, you know, whether markets are going up or down, economy is going up or down, people still want to brush their teeth. They want to drink their tea, and these consumer product companies are very stable. So they're low volatility stocks. Also, I'm sure you guys are familiar with technical indicators. These are very popular with investors. Things like Bollinger Bands, candlestick patterns, golden cross, moving averages, relative strength index. All of these technical indicators, basically stock market ka hi data lete hain. They take the data from price and volume, and uske pattern se they try to decide what is going to happen next. So if you are depending on the price and volume data, that is a technical indicator. There are some other indicators which you may not have heard of. One example is investor holding. If you know who is buying or selling the stock, you can have some sense of where the stock will go. So, for example, you can track whether the insiders, the management, the founders are selling shares or buying back shares. You can also see whether large mutual funds, foreign investors are buying that share or selling that share. That gives you an indication that baki investors is company ke bare mein kya sochte hain. Next, there is a factor called index participation. In index participation, the macro impact of getting included in an index is what we are looking at. So when a company becomes part of Nifty 50, every 6 months, you should know, the company that manages the Nifty index decides which 50 companies will be part of Nifty. It's not fixed. Every 6 months it changes. And the companies that go into the index generally see their prices go up more than the companies which come out of the index, just because a lot of people are buying just index funds, particularly many index funds. They are only investing in the whole index. And if you're only investing in the whole index, then the demand for anything that is included in the index automatically goes up. Whether individually people are liking it or not liking it, doesn't matter. Pura ka pura basket goes up because every index fund has to invest in those 50 companies. So we also look at things like index participation. Then we have macro environment factors like what is happening to interest rate, GDP growth, inflation, demographics, exchange rate. And all of these obviously influence stock market prices. So these are important things to understand and have a view. This is very popular in talk show hosts. So जब भी आप TV on करते हैं, there is somebody sitting there giving you gyan about how the macroeconomic environment is going to impact the stock market prices in next 6 months, 3 months, 1 year. They are definitely important. Elections are important. A political leaning of the country is important. What is happening to the exchange rate, interest rates, the cycle the economy is going through, all of that are very important in deciding what is going to happen to the stock market. But how do you combine a lot of these things together? Not only these factors, but there are sectors that one has to worry about. But let me first give you a little insight on how important are these factors. Now, I don't know if you guys are able to comment. I guess this is being broadcast on YouTube. You can put your comments. So put which of these factors is most important. Now, no matter which of these factors do you think is most important, you were probably right because all of them were important at one point or the other. This colorful chart shows which factor was the highest performing factor in any given year. So in 2007, the time was that of value. 2008, as the volatility was high with, basically पूरी दुनिया में बहुत ही volatility or down bear market चल रहा था. So low volatility stocks did very well. And if you look at some of the later years like 2015, 16, 17, even 19, momentum did very, very well and continues to do well right up till to 2022. If you were investing in momentum funds or small cases or using that as a strategy, 2022 was not a good year for you. So if you look at only one way of investing, then you'll have some good years, some bad years. Now, what about sectors? So this is same kind of chart, but looking at which sector did well. Again, the story is similar. Depending on the year, the sector which did very well rotates. So in 2021, utilities did very well. Industrials, real estate did very well, and healthcare and consumers didn't do well. Now, healthcare did very well in 2020 as COVID spread, and a lot of momentum was there in healthcare sector. So depending on the year, the outcome of which sector does well is widely varying. और क्या change हो सकता है? A lot of you probably think of, I'm going to get and find small caps, the new exciting companies which are going to be growing very rapidly. Well, let's see how that performs. In this chart, we are showing what was the return of three types of companies: Nifty 100, which are large caps, mid caps, and small caps. Now, if you look at it, yeah, there is more green in small cap, but there is also quite a bit of pink or red in there. So again, in 2022, the markets changed. Nifty 100 did very well and small caps didn't do well. So if you were only investing in small caps, looking at what had happened in 2021, jab small caps were doing extremely well, then you would not have been happy in 2022. Net, the purpose of showing you all of this data is market cannot be understood by looking at in only one way. Don't be the blind man and the elephant story. Don't look at the market in only one way. So what do? A good investor in quant funds looks at all of these factors, puts together the factors, and creates one balanced portfolio. So how you create that is the real trick. How do you balance factors like momentum, value, growth, volatility, index participation, which sector they belong to, whether they are mid cap, small cap? How do you put all of this together is very important in creating a balanced portfolio, kind of all weather portfolio, no matter whether markets are going up or down, which sector is up or down. You have to try to bring balance to your overall portfolio. And that method is what we follow when we try to build these strategies. Now, we look at 130 plus factors across all of these types of things. And we put it together combined with macro factors. I'll show you in a second how do we do this. But we put it together, combining it with macro and regime factors, and then create a single portfolio, which has done very well. It has a cumulative return of 56% since its launch in 2020. So it has done very well. It consistently performs well. You can see the track record online on, I'm sure, on your Done website, where their small cases are listed as well. So let me talk a bit more about how the process works. So the building blocks I already covered with you. We have dynamic factors that we combine together. We look at index participation, institutional holding, which sector do they belong to, market microstructure, which is another way of saying technical indicator. These are all the things like RSI, Bollinger Band, all of the technical indicators that you can put together. And there are so many ideas. We use over 130 of these, but if you do literature survey, agar aap log, just Google or go to scholar.google and type factors important for investing or something like that, you can find thousands of papers. And there are some literature surveys which count over 1,000 factors which people have speculated or postulated that these are good factors. And no matter which expert you talk to, they're going to have some knowledge where they'll say, this is the golden ticket. This particular factor is what is going to get you good, consistent returns. And they'll have good data to show that too. Now, the only problem is usually they show 1 or 2 years of data. And of course, everything works for 1 or 2 years, but it keeps changing. So if you are always working with what worked last year, you are likely not to make money because, it changes. And usually when it works, right after that, it doesn't work at all. And that's a big, tricky situation to handle. Now, so we take all these 130 factors and we create what we call our multi-signal library. So think of it as a recipe book or a menu book with 130 different recipes or ways in which we can construct our portfolio. Then we look at what has been the performance of each of these factors at different time periods. पिछले 1 महीने में क्या काम किया, 3 महीने में क्या काम किया, 6 महीने में, 1 साल में. And we have our own way in which we estimate what is the likelihood that this trend is there and it will continue for next 1 month. We also look at the macro regime. We look at 18 factors, just say inflation, interest rate, GDP growth, all the macroeconomic factors. And we have our own view that given a macroeconomic condition, which of these factors will perform better. So combining the recent performance as well as macro regime, we then change the weight of these factors to come up with what we think are the best factors to use going forward. And then we create the portfolio. And then once a month, we do the whole process again. Now, this can be done obviously daily. It can be done weekly, monthly, annually. We build models at all these frequencies. So we know how to adjust our portfolio every day, how to adjust it once a week, once a month, once a year. For our investment advisory clients, we recommend stay once a month. Why? Because अगर आप हर दिन ट्रेड करेंगे, then even though the return can technically be higher, but your transaction cost will be very high, slippage will be high, and it'll take a lot of time. If you have to spend so much time every day, when will you do your work? When will you attend to your family? When will you do your other social obligations and fun things in life? So life is not just about investment and trading. It should be the right balance between taking proper time and growing your money and enjoying everything else that is available in life. So for retail investors, we recommend balancing once a month. That is what we provide through our partners, and tell them once a month how to adjust their portfolios. Now, why does this approach kind of add value? So some of these things I've already covered, but just to summarize, we don't just look at one factor. We don't just look at the popular factors. We constantly monitor over 130 factors. We also look at 18 global and macro factors and what is its impact on the 130 strategies that we are running. We rotate based on recent performance as well as the macro regime that we are in. Then we test this over 15 years of data to see how it is going to perform. Now we have the ability to test it over a lot longer period, but really Indian markets have been changing so dramatically that testing it over a longer period of time is not really useful. Markets have changed quite a bit after mid 90s, even early 2000. The markets have been very different. Nifty was kind of a new product in mid 90s, and electronic trading, foreign investors, a lot of retail participation only started coming in last about 10 years. So that's the data we focus on. Our system does not get greedy or fearful. आप सबने बड़ी famous saying है, become greedy when everyone is fearful and become fearful when everyone is greedy. Warren Buffett said this in one of his letters. And I think this is a very good way of understanding how to handle your emotions when you're investing. A lot of investors, there was this SEBI report that came out earlier this year, in which they said almost 90% of active traders lose money. So if you are out there trying to predict कि निफ्टी ऊपर जाएगा, नीचे जाएगा, कॉल खरीदूं, पुट खरीदूं, कि क्या करूं, you're likely not making a lot of money unless you are one of those 10 people who did some profit. And there also the average profit was only a couple of lakh rupees. So it is not going to be something on which you can live your life or be very profitable and generate a lot of income from. It's much better to systematically invest over long periods of time without getting greedy or fearful. A systematic system, an algo-based system, achieves that very easily because we don't have any portfolio managers who's getting fearful or greedy. We also don't have impact of other emotions. If we have a fight with our spouse, घर में कुछ झगड़ा हो गया या कुछ हो गया, it does not impact how our investments will do because our research and our processes are very systematic. Okay, so as they say, ये तो सब वही बातें. What is the result? So let's look at the result that we have been able to produce. So using this method, these are the results that are available online on Gullak. I'm sure if you go to your Dhan website and look at the Gullak Gear 6 investment, then you will see this thing. Now, let me take a minute to talk about Gear 6 versus other gears. So on our small case page, you will see that there is Gear 2, 3, 4, 5, 6. What is the difference? The idea is we do not provide 20 different flavors. We do not provide you a small cap fund, a mid cap fund. We don't provide a technology fund or a growth fund or we don't want you to think about investment in those terms. So why 4 or 5 of these gears? The only difference is that investors' situation demand sometimes to be more conservative than aggressive. And sometimes it calls for being more aggressive than conservative. Gear 6 is all equity portfolio. This is equivalent of saying, I'm saving for 30 years from now when I'll be retired. And I'm going to keep putting money every month, every year. And what is the right portfolio for me? Gear 6. If you are a retired person, you are already 75 years old, you have some savings, and every year you have some expenditure, and you don't have any more earnings except what you're earning from your portfolio, then you have to be in a lower gear. You have to be in gear 2, 3, maybe at most 4, because you don't want too much volatility in your portfolio value. But if you are looking for 40 years out, you want the full exposure to market. Now, on average, stock market produces about 11% return, somewhere around that, 11, 12% return. And fixed income can produce 6, 7, 8% return. These days, it's getting quite high, maybe 7, 8% return can be generated. So that's the difference. The average return difference is maybe 3 to 4%. But 3 to 4% over 30 to 40 years can produce 3 to 4 times the money that you would have if you have exposure to equities versus exposure to fixed income. So for long-term investors, investing in equities is the right answer. For short-term investors, investing in more fixed income is the right answer. So depending on your situation, you have to pick the gear. That's why we provide 5 different options on how aggressive you want to be. Now, this is showing just the results for Gear 6. Gear 6 portfolio since launch has produced, as we mentioned, over 56% compounded return. The blue line represents what it has done. The orange line represents what Nifty Multicap has done. And year by year, you can see we have outperformed what Nifty has done very, very significantly. Now, so I guess this is the same chart just showing the Nifty Multicap with Gear 6. I think I just covered it. Lots of investors from all over the country, well over thousands now are using our product. As I mentioned, they can rebalance their portfolio with a single click and execute the rebalance portfolio. We try to make it as easy as possible. Now, good news is that our team, in collaboration with Dhan, has decided to offer a special discount code called Dhan50 on our 3 and 6 month plans on all Gullak portfolios. This is valid till July 15th or the first 100 subscribers, whichever is earlier. So I hope many of you will take benefit of this if you have liked what you have heard. So Dhan50, that's the code. Finally, I would welcome you to follow me or Gullak or both on our social media presence. I am active on LinkedIn and Twitter. Here are you can Google me or look at the LinkedIn or Twitter on S. Tyagi is my tag name on both these platforms. And on Gullak, you can go to LinkedIn, Twitter, or Instagram and search for Gullak. And then we continue posting interesting investment and savings related content. And you're welcome to ask us any questions and engage with us online. So that's what I wanted to cover. We are pretty much at half an hour mark, and I'm happy to answer any questions.
Awesome. Thank you, Sandeep sir. Sandeep sir, is it possible? Yeah. Thanks for a very insightful session, Sandeep sir. I was like skimming through all those the whole thing very diligently, and I was actually writing down notes as well. Few like during one of the few slides. We have got some interesting questions actually, Sandeep sir, which I believe that users might be benefited by it. Starting from a very light-hearted one, what actually inspired you to name the small cases after gears, basically?
Yeah. So, I'll give you the analogy. When we drive, अभी तो सब लोग automatic गाड़ी drive करते हैं, but some of you maybe remember, maybe when you were younger, stick shift हुआ करती थी. You used to drive using a stick shift car, and many people still do. I think they're still very, very popular. और stick shift में gear select करना पड़ता था. Now, when you started a car, you put it in gear 1, and depending on the situation and your own capability, you use a higher gear. So agar it's a beautiful day, दिन है, खूब रोशनी है, road is dry, there is straight road, no traffic, early morning you're going to put your car in whatever highest gear that is there in the car, gear 5 or 6 or something, and you'll go at full speed.
Right.
But if it's raining very heavily, you are driving in mountains, and it's very dark, तभी आप लोग क्या करेंगे? You are going to put your car in gear 2 or drive slowly, cautiously, because you don't want to take the risk. You can slip, you can have an accident, and you will be very cautious. So depending on situation and depending on your own capability, you pick a gear to drive your car. Similarly, in investment, depending on your situation, जैसे मैंने बताया, if you are close to retirement or you are not earning anymore, but only using your savings, versus if you are a 25-year-old whose whole career is in front of them and they're going to be saving for 40 years, you should be investing very differently. And that is why we picked the analogy of gear to say asset allocation is very important. How cautious you are in investing is very important. And you should think of it just like driving. कि कौन सी gear में गाड़ी चलानी.
Understood. Yeah. Very, very thoughtful analogy, Sandeep sir. Now, sir, one of the important questions actually were what are the few things actually which makes the multi-factor investing challenging, and what are the scenarios it won't work actually for a lot of investors?
Yeah. So multi-factor investment is time consuming, and it takes a lot of effort. So if you want to do it on your own, it's very easy to go to a dinner party with your friends and आपके किसी दोस्त ने बताया यार मैं तो पैसा इन्वेस्ट किया था एशियन पेंट में या HDFC बैंक में और मेरा तो 5 साल में पैसा 10 गुना हो गया, और I have invested in this hot stock tip that I have received on WhatsApp. That's very easy. It takes 2 minutes to read a WhatsApp message and go buy something. But if you want to build a multi-factor model, we have team of over 100 people, and we have people who have spent good effort to get degrees from places like IIT, IIMs, and NSITs and other great colleges, tough programs, to learn to do a lot of work with computers and with a lot of data. We buy a lot of data. So literally from Bloomberg, Reuters, Morningstar, all the exchanges, we collect a lot of information. Now that has to be processed. It's not just reading some social media posts or some news articles. It's collecting gigabytes of data every day. Now, so you need to have people and skill sets, you need to have a lot of data, and you have to have a lot of compute power. So, which means you've got to be able to test. If my hypothesis is if the stock has gone up for last 3 months, it will continue to go up. Well, test it. See what has happened in last 15 years. How many stocks which went up for 3 months continue to go up next month? So this kind of computation and testing takes a lot of effort. So you need compute power, a lot of servers and machines to do all of that. Now, putting it all together takes a lot of effort and to do so. So multi-factor investment is different because a fundamental investor or a intuition-based investor typically, keeps listening to the news, TV, the Lal Street, social media, consumes a lot of information, and all of that stuff is happening in their mind. Then they say, oh, I'm going to buy this stock or I'm going to sell this stock. For multi-factor systematic investment, you have to have all of these components that I described. So it's not really easy or possible for an individual to do. But that's what we do professionally and make it available as a model portfolio. That's the output. One more example I'll give you. If you think of what is different between, I don't know what's the most popular fast food, like take McDonald's or Pizza Hut, versus the guy selling some local snack or chaat on the corner store. What's the difference? The difference is you may have a very good person who sells very particular snack that you like a vada pav or chaat or something that you find is great. The person is very good. But if you go to a systematic provider of the same thing, they measure humidity of the potatoes that they buy. They measure how many seconds will the potato fry will be in hot oil. What would be the temperature of the oil? Everything is systematic. That's the difference. So you may find a good investor, but you don't know next time you go to that investor whether they'll be able to perform or not, whether you will get some illness because they were not very clean. But if you go to a systematic place, then they have spent years perfecting what they need to produce a consistent experience. What are you going to get is consistency, systematic output. So that's the difference between what we do and what kind of effort it takes.
Awesome. I really hope this answers the question to our users. Sandeep sir, like right now on the market fronts, actually, right? Nifty is like basically going sideways or like just around it's around like 18,500 or below 19,000 for a longest period of time now. How do you see it's going to pan out in the coming weeks, and how does you position your small cases based on that?
So look, I think small case, the gears that I described, if you're becoming very uncomfortable that the market has a lot of risk, then shift gear down. Same analogy as driving. Right? अगर आपको लग रहा है कि सामने सड़क थोड़ी खराब है, मौसम खराब है, तो gear थोड़ा, be conservative. Don't drive at full speed. However, when we do research, this is all about handling your own emotion. आपका अगर इमोशनल संतुलन ठीक नहीं है, परेशानी हो रही है, रात को नींद नहीं आ रही ठीक से, ये क्या हो जाएगा, बहुत लॉस तो नहीं हो जाएगा, then it's better to reduce the gear, go down to a lower gear. However, if you look at actual data and you say for somebody who's investing over a long period of time, the best possible approach is keep investing systematically. Month after month, you are going to get the best returns, and rebalance between fixed income and equities. If you want to be 70% in equities, 30% in fixed income, market has gone up a lot, sell some equities and put it back in fixed income. If market has gone down a lot, break some FDs, put the money back in market. And that's the opposite of what people do. जब भी मार्केट ऊपर जा रहा है तो everybody takes money out, they even take loans and they put it into stock market. And when the market is going down, they sell everything and put everything in fixed deposit. Exact opposite of what they should be doing. Right. So consistency and having a stable asset allocation is the right approach. Agar emotions are bothering you, reduce your risk level.
Understand. Awesome. So coming back on the same topic actually as rebalancing, right, Sandeep sir, how frequently do you Gulag team rebalances and sets the rebalance updates and everything? How frequently you track it, and like how are the users get to know about it?
Yes. So I think I mentioned that we suggest once a month is the right approach for a retail investor. We do have annual models. We know that rebalancing once a month provides much better returns than the annual model. So we think that doing less frequently than once a month is not optimal. We could provide once a day, but the problem with that is it creates too much of a burden on the investor. They have to visit the website every day. They have to watch what it got executed. And some people have high costs of brokerage and other transaction costs. So that will increase their cost a lot as well. So we think that once a month is sufficient to look at your portfolio and rebalance.
Awesome. Sandeep sir, I would actually like to draw upon your vast experience of investing and like portfolio management per se. A lot of our users actually get confused on if they have a certain pool of capital with them, how should they go about it when investing in? If suppose they have like 10 lakhs they would like to invest, what kind of small cases like they should think about, and like basically their portfolio allocation should be in this way, depending obviously on the risk management practice. But can you please like shed some light on that?
Sure. So as I think I've been suggesting, if this person who is, let's say, investing 10 lakhs, this person is a 25-year-old and has a good prospect of job, that they are going to have a salary or some income on a consistent basis for the next 30, 40 years, they should be investing in Gear 6. If they are emotionally not able to handle, that the market can go down 30, 40%. It has in last 15 years, it has corrected 40, 50 years in 2008, and it corrected suddenly in 2020 due to COVID also almost 30%. So it can go down 30%. If you're not able to handle it, please don't put your money this way. But if you're able to handle it and you have a long runway ahead of you, go in Gear 6. If not, if the opposite is true, you are much older or emotionally you need more security, stay in Gear 3, 4. Now let's take somebody in the middle. Let's say you are 35, 40 years old, you kind of have some expenses, some not. Somewhere in the middle. Then a good way to think about this is maybe not 100% equity, but lower. But don't forget, this is overall. And not, obviously, you are probably not going to put all your money into good luck products. You will have other things. You may have a bank deposit, you may have a real estate, you may have bought an apartment, you may have some gold. So you will have other assets as well. Your fixed deposit, your gold, even your real estate is more like a fixed income investment. So if you have overall 10 lakhs to invest, but you have 15 lakhs that you have in the equity of your home and in gold and in fixed deposit, then you are only putting 40% in equity, and it's okay to put that 40% in Gear 6. But if that is your total savings, if all 25 is available, you're renting a home, you don't have that asset, you don't have any fixed deposit, and all the money you're going to put in a small case, then I would recommend keeping a Gear 4 is better.
Okay. Thank you, Sandeep sir. Sir, I believe that there are no more questions from the users end also, and we have almost covered all the important ones. Again, reiterating on the same thing, we actually have a surprise for you, as like Sandeep sir also mentioned a while ago. You can opt for Gulag small cases, and there's a discount of 50% on all of them. Just use the code DONE50, and we look forward to more such sessions, Sandeep sir. Thanks for taking out your time today.
Thank you so much. Appreciate it.
Thank you.